The Ensemble podcast is intended for professional financial advisors. This content is created in partnership with our sponsor, Innova Asset Management Proprietary Limited, ABN 99141 597 104, AFSL 509 578, and is limited to publicly available information. Before acting on any general advice, you should consider whether appropriate and obtain financial advice from a qualified financial advisor. Ensemble does not hold an AFS license and does not provide any financial advice or services or endorse any general advice. If a PDS or IM exists, you should obtain a copy and review it thoroughly before making a decision.
Hey guys, this is Ben Nash from Pivot Wealth and one of the Ensemble co-founders, and I'm pumped to be involved in the investment podcast for Ensemble. Our advice business is built around younger, higher income clients where investments is a big part of the picture. And the Ensemble crew have asked me to host this podcast where I'll be sitting down with some of the sharpest people in the market to talk about portfolio construction, asset allocation, the mindset and psychology side of investing, and what's actually working right now.
This podcast is proudly brought to you by Innova Asset Management, a leading provider of goals-based, risk-managed SMAs. Innova empowers financial advisors to align client portfolios with their natural behaviour and long-term objectives. Their evidence-based approach combines dynamic asset allocation with a deep understanding of investor psychology, helping to reduce value-destructive behaviours. With a proven track record since 2012, Innova offers traditional and behavioural portfolios designed to deliver consistent outcomes across diverse market conditions. Learn more at innovaam.com.au.
All right, guys. So welcome back to the investment series on the Ensemble podcast. Today, I'm chatting to Dan Miles. Dan is from Innova, where he's the co-chief investment officer and managing director over there. So we're going to get deep into investments, talk a bit about portfolios, a bit about human beings and their brains. So Dan, I'm keen to get into it, mate.
Yeah, looking forward to it. Why don't we start? Why don't I very quickly, what's your background, Ben? You've got my bio there. What is your bio claim? Can I look it up and have a read of it?
Oh, for sure. So look, a few people will be familiar with that from previous podcasts, and as one of the co-founders of Ensemble as well. But my business, Pivot Wealth, we're Sydney-based, work with higher income accumulators. This is our 11th year this year. Predominantly, we're sort of in that sort of Henry market-ish, 30s and 40s primarily. Increasingly, they have more and more assets to manage, and so we've got a team of 11 advisors as of today. And one of my sort of key functions in the business is working with our head of our delivery team and the head of the advice team to do things like, structure portfolios. We just had a bit of an emergency session this morning around the budget changes and all the fun stuff that the government have been so kind to throw into our laps over the last couple of weeks. And the investments was a big chunk of that because, and I'm sure we'll get into it, but one of the things that I think is increasingly important at the moment is, obviously you want to be strategic within the rules that we've got, but now that basically the whole rule book has essentially shifted, I think that being selective with what you're investing into and where you're holding those investments, it's always been important, but I think it's increasingly important. I was saying to our guys that I think it's one of the biggest ways that we can add some really material value into our clients. So
absolutely. And in fact, that was one of the biggest things that advisors had done because of the amount of value it can add. And now it's even more poignant and it needs to be reassessed and needs to be re-looked at. I couldn't agree more. Do you guys utilize, we refer to the common strategic asset allocation portfolios, conservative, moderately conservative, balanced, etc., as traditional, because that's traditionally what people have done. Do you guys ascribe to that and utilize those as some of the investment solutions for those high net worths? Is it more around trying to achieve a goal and therefore the portfolio might have a mix of that as a core with some other parts because of a certain, requirement, whether it's growth or income? Or I don't actually think that way. But anyway, so is that how you guys release?
Yeah, so we largely work around, risk profiles, which is essentially the most important part is the split between your growth and your defensive investments, and broadly follow the, conservative balanced growth, high growth, as ASIC, tells us to do. But one of the things that we do quite a lot with our clients is to look at their global portfolio, because clients will typically they've got maybe some investments in their own name, then they've got their superannuation, then they've got investment bonds, family trusts. As I jokingly said off camera, at least until last Tuesday, they had family trusts, investment companies as well. And so we're looking for our high growth investors, we're 90% equities, and we're sort of 60-40 Australian, international. But now I think it makes even more of a difference where you're holding your Aussie versus where you're holding your international, when you look at the return profiles of those investments, and which have franking credits, which don't, which have higher incomes, which are higher growth. And there are different entities, because our clients are more in that sort of $400,000-$500,000 plus income type level, saving at a pretty solid clip. They're building their assets and their investments relatively quickly. And so we know that, getting that structuring right, we still are very passive in our investment approach, where 90+% of our overall client investments would be in index type funds. But being strategic with those index funds and where we put them, I think makes a big difference, or at least we find makes a big difference overall. How do you guys think about it?
How we think that portfolio construction could be probably reinvented or probably rethought of is, well, first of all, as an industry, we've done a terrible job of providing advisors with tools to deliver better advice. We just haven't done it. Everything has come from an investment or an insurance institution landscape, and then tried to be slightly tweaked and then forced into an advisory framework. And we think we should be starting from the advisory framework to begin with. There's no one answer to it. One of the solutions I hopefully will get a chance to discuss today is not just the investment component, but how those investments, as you mentioned, in regards to different structures, you might have different goals, different portfolio, different time horizons, how you can put portfolios together that are more relevant to the client and more understandable to the client. And nobody likes to talk about risk because they find it really boring. But most clients who, the majority of the wealth is in people over the age of 50, they're going to have experienced at least the GFC, and some of them will remember the tech crack. So to them, losing money, even if it's just on paper, they may not be realized gains, can be very frightening and cause them to do silly things. So we think that one of the solutions that probably would fit better for advisors, not for every client, not for every advice firm, but portfolios that, kind of say on the box what kind of risk they are trying to manage to and not breach, whilst always maximizing return. And I think that's probably a more meaningful conversation with a client when you can say, well, they can't guarantee it, but this is, because it's definitely not a guarantee, by the way. We're not talking about a guarantee. For this pot of money or in this trust with this so-and-so, with this time horizon, your tolerance, your sleep at night factor, you can't handle seeing a loss on paper of more than an amount. For other components where you need to take on more risk because you need to grow some wealth, you need to build some wealth, or you might just want to, even if you don't need it. It's this amount. And then for the really longer term stuff, the aspirational stuff, the more relevant risk is things like longevity risk. It's the ability to pass on a bequest. It's leaving a legacy. It's outliving your savings, right? Which is longevity risk.
Yep.
Drawdown might cause you to do something dumb. So this amount is kind of the threshold at which a portfolio is going to try and not breach, whilst always maximizing return. And I think, well, from I talk to lots of advisors and have done ever since I was an early teenager. Advisors, it generally resonates with a lot better because clients don't care what your asset allocation is. They just want you to get the result. Majority of them don't even know what the hell you're talking about with asset allocation.
Mm.
Most of them don't know why they own equities. They don't know why they own shares, apart from, or they go up over time and you let your portfolio go up. Yeah. So that being the case, do what is relevant that they can understand and, don't do something that isn't already on the box and spell it out clearly. And on top of that, I think from the institutional framework, institutions hated the idea of bucketing. They hated the idea of compartmentalizing assets and compartmentalizing goals. And so there's been this rhetoric, I think, in the last 15 years that has made advisors try to feel as if they're kind of too old school or inferior if they compartmentalize assets or compartmentalize goals with different assets. The reality is that that's nonsense. Compartmentalizing, having a suite of assets or a portfolio for a specific thing and having 2 or 3 or 4 of them, whilst it makes the communication with the client a lot easier, it actually taps into a whole bunch of behavioral components of the brain that help clients increase their buy-in and their understanding of what they're doing and how they're doing it. But we as an industry have done a terrible, terrible job of trying to help advisors show that and demonstrate that to clients. And so they had to do it by themselves. So we're a supporter of compartmentalizing. And we think the combination of the two of portfolios managed to a risk the client's concern and compartmentalizing the right way is going to increase the likelihood of achieving goals.
Absolutely. Yeah. That's what I was going to say. It's like whether the instos think that it's the right thing to do or not, that's how people think about their money. And I'm sure that a lot of the advisors listening would be able to resonate with the fact that, when you work with a client and you're building their financial models, that often for us as the advisors that you're going like, okay, well, they might come to you and they've got, money in a savings account here, or they've got some, equities in different buckets there, but you just go, okay, well, they got this much cash and they got this much equities. And then you build your model and you plan around it. And then, but the clients go, oh, but that money that I had that there for that purpose. It's baked into their brain. So it makes so much sense to be able to do that. And look, I should have probably qualified that. I think one of the things that makes our life a little bit easier at Pivot Wealth from an investment perspective is the fact that because our clients are all accumulators and they're all aspirational, it means that we haven't had to invest a heap of time in figuring out, the right rules around generation. We have had a few clients that have got, significant exits from businesses or, really large inheritances, and we create bespoke, approach to not necessarily so as much the investments, which of course we do, but more about like the cash flow management of it all. And, what have we got from an income perspective? What have we got in that growth bucket? And we probably haven't labeled it in exactly that way, but we absolutely do it. But one question, sorry, that came to mind as you were saying that last bit, you're talking a bit about longevity risk there. What are your thoughts on the fact that you see, we've got this business coach and he's right into tech and AI and, all of this different stuff. And every year he goes to this conference and it's like, so they have some big ones in the States and they're talking about all this crazy stuff that happens in the medical space in particular. How do you think about longevity risk when they talk about, the nanobots are coming and then we're all going to live to we're 195 or whatever? Like, does that factor into portfolios? Because I know for us with clients, like particularly in the rare ones that we get in the older sense, are like, well, sometimes people are looking to run down their assets, but I feel like that's increasingly risky with all of the advances that's seen.
Absolutely. Yeah. Running down there, and it's kind of out of trend too. Like, correct me if you don't agree, but I remember the whole where it was kind of celebrated by people in retirement, the boomers going, oh, you know what? Spend the retirement savings. I remember seeing there was an ad for something showing the grey nomads and they're like, yeah, we're spending the kids' inheritance. Whereas, I don't know, I've seen this distinct trend from feedback with advisors to me, because I don't have a book of end clients. I often present in front of them and in groups, but I don't see them day to day. But there's this trend that retirees now who have got grandkids, it's less about exhausting the inheritance and enjoying it. It's more about spending it now so they can see the benefit, particularly with their grandkids. And it's not about that exhaustion thing. Now, does longevity risk and the ability to live to 190 play into account? Yeah, yes, I absolutely think it is. I absolutely think it does. And it needs to be considered. But whether it's 190 or it's 100 or it's something else, the amount of money that somebody's got, the way that they invest, and the behaviors that they display are going to always have an enormous impact on where the money can go. And there may be capacity constraints around how long it could last. So, outliving your savings is absolutely a potential concern for a lot of clients. But I would say that the vast majority of retirees in Australia right now, and the majority of clients of advisors who are listening in on this at the moment, are not in the bucket of, oh, they've got so much money that they don't need to take on risk because it'll last forever anyway. And more of them about, well, I mean, I've run, I don't know how many models we've done, many Monte Carlo simulations of them, but you've got less than $1 million. You often have the very frugal, very good with money, very tight people and retirees that are just used to not spending a lot. But then you've got the others that believe that they can spend and the money will just always be there. 700 grand, 900 grand for a couple, and their essential spending is probably 70, 80 grand a year, something like that, probably more. I don't know how me and my wife could live off 70, 80 grand a year, even if our kids were independent, and I'd paid off the mortgage. I just can't see how we'd be able to do it.
It puts the ASFA standards into perspective. I look at those numbers and just think, how is that working?
Well, to be honest, Ada, I'll come back to that because it's a good point. But then it's more about, well, your money on average will probably only last till you're 79, give or take. Could be as soon as 74. It might last until 81, 82. And it's less about, could you live to be 190 and we need to plan for that, because that's an unknown. It's an outside probability, and it may not even, and it's not within your control. Planning for it is within your control, but it might not be possible. What is probably more relevant, more prevalent, is that whole, well, your money with current spending and how you're invested and your current behaviors, you're likely to run out of dough before you turn 80. So the risk is that you live beyond 80, which is a very high probability, or you live beyond 86 or whatever. And so that should always be, I believe, incorporated into conversations, because we kind of went down a path for a little while there where everything was about sequencing risk, and people were trying to describe what sequencing risk was and drawdowns, and therefore focus on the income and But sequencing risk and longevity risk are hand in hand, because it might be all well and good that a glide path option that's out there puts you in more defensive, and I hate that word defensive, put you in defensive assets over time. Yeah, okay, fantastic. So when the market draws down, you don't draw down as much and you're not taking the money out or spending it's not there to bounce back. Fine. But if it doesn't have enough potential to actually compound and grow over time, you've got another problem, and that is living off, white bread and tin beans, and the age pension, which is just, it's just not comfortable. It's just not a great outcome. And so the two of them should always be thought of and addressed together. And I think I know this is rude in science. The compartmentalisation idea of having assets for goals that may be to focus on this in the shorter term, but this component, markets moving around, markets crashing, Donald Trump blowing things up and causing volatility. That's not the kind of risk you need to worry about. The risk is that you could outlive your money. And always think about that. So that's why that's there. So year on year, month on month, week on week, it's irrelevant what is going on inside there. the main thing is that it needs to grow enough so that if you are healthy and you do well, that you'll still have some money left over. And the age pension stuff, it's bizarre that you get, like, I just cannot imagine people who are in the process of about to retire, people from Gen X and probably Gen Y, being able to live off anything close to the age pension. But I do know people that, and retirees who have grown up and learned to be quite frugal, who don't spend enough. And often advisors have to convince them, no, you're going to be okay. You can spend this and enjoy this. There's no point in accumulating it. Yes, your family and offspring or whoever you decide are going to benefit from it. But you should still at least be able to enjoy the later years of your life. That's a very long-winded answer to your 190-year question.
No, I get it. We see this a lot with clients where it's like, and I would agree with you that I think that the majority of people probably they find it easier to spend money than to not spend money. But then you do have that subset that they need to really be pushed to do that. I find that with older people as well, sometimes younger people as well, because like the FIRE movement and, the people that get sort of swept up in all of that. And I think it's got there are a lot of great elements to that, but you see people that really take it to the extreme. And I know we've had conversations with clients, you go, when you model things out, you go, your trajectory is so strong, do you really want to only have a holiday every 3 years just so that you can get an even bigger number? Because sort of why?
Yeah, why? And it comes in that, look, I'll tie back to the compartmentalizing thing, how that works and how you can have that conversation with them and show them they'll be fine. And then also why I think managing a portfolio to risk and not having a single definition of risk, having multiple definitions of risk that are relevant for the client actually makes, I think, a lot more sense and should be easier conversations between an advisor and the client. The compartmentalizing thing, if you can, if you want to, if you are dealing with someone who's retired, if you're not dealing with someone pre-retirement, but it's just as valid to them, I'm just trying to zero in to make an example that's useful for the listener. If you've got those clients that are, you have trouble getting them to spend, or they spend too much, or they're nervous, or they watch markets too frequently, by having assets there relevant to the goals they got and the amount of risk they need to take, balanced with the amount they can tolerate, blocking them up into time horizons to match those goals taps into elements of the human brain that help reinforce it or potentially blow it up. So you'd mentioned that you had followed that and you'd been more focused on the cash flow management component, etc. There hasn't been many scientific tools that have been provided to advisors, and there hasn't been a huge amount of science that's published on this, but I think it's pretty easy to understand. You can't predict the future. No one can. Clients especially know and feel uncomfortable. That's why they're uncomfortable, because they don't know what's going to happen in the future. If you provide them some form of structure, perceived or otherwise, if they get an idea of structure and that there's some kind of structure in amongst this chaos, they're far more likely to anchor to it and feel more comfortable, and far less likely to run off and do their own thing because it's so uncertain. So that's what's called the framing effect. On top of that, as you mentioned, clients have goals and say, oh, but I've got those for that and I've got those for that. That's mental accounting. And it's just easy for us to think and go, that's linked to that. And if you combine the two together, framing, and you've got this suite of assets / portfolio for these goals, you combine that structure in a world of uncertainty, which makes them more comfortable and increases buy-in, with the fact that we think in terms of mental accounting and owning this to offset that. It's actually an embedded, implied asset liability matching type thing that pension funds do for their own future liabilities, but humans do by accident without knowing that they do it. I always use the word hijack. It's not hijack. You can use that to your benefit by framing. Okay, over these time horizons, you've got these requirements. It may just be you need this much to live on. We need to generate that amount of income, like you mentioned, and we need to do the management of your cash flows around that. And that's a bucket, a compartment, a goal allocated to. And if it is then managed in a way that is like, look, it's managed to this amount of market volatility, you hold it for this period of time, get this amount of income, own these kind of assets that you can be secure about, that should theoretically be the main focus, or that's what the advisor says. Look, you just need to look at that and worry about that. But if the risk is longevity risk, or it's the ability to pass on a request to a future tax event, or whatever the case may be, this part, the risk is that we can't achieve that goal, not markets bouncing around. But I know that you freak out if we had less than X, Y, and Z. So portfolios managed to that risk, to that market risk, and clients understand it. It's much easier to understand how much the losses are than it is to understand volatility. And it's there to grow over time. That's the part that we worry about in the longer term. You've combined those things together in terms of goals, framing, referencing for the client, increasing the likelihood of their buy-in, and combined together not only human behavior, but hopefully decent asset management where people are managing to risks that are the types of things that cause clients to blow up and move and go and do something
for sure. And I was just going to ask, what are the most common like buckets or goals that you say you're attaching your investments and your buckets of money to particular goals? And you mentioned some there around income, but like you see inside a lot of advice businesses, what are the most common ones, or the ones that you think are most relevant that people should be thinking about?
The most common is the short-term income requirement, often funded through cash or term deposits. Although since we had zero interest rate policy post-COVID and in Australia and pre-COVID in overseas, and then you've had the bond volatility of 2022, and TD's not paying jack all. People are kind of a little bit hamstrung there, but generally just, like I say, cash allocation bucket to say this will fund your income for however long. Then the other component, the simplest thing, is that people just put it into another portfolio that in some way balances out the tolerance, etc. What I think is more relevant, is not as popular, is to think about goals in terms of duration and importance. And, if it resonates with people, the way we've kind of talked about it, we've actually talked about it irrespective of what age you are. You can be 70 or you can be 45, but it's kind of safety, lifestyle, and future or aspirational component. And the safe is that income bit. It is that you need to get this sort of income. It is not negotiable. So that's what we need to do. And that'll be a function of how much you need and how much you've got to allocate to it. If we're talking in terms of finances. If we're talking in terms of somebody who's, your or my age, it's safety is the ability to, depending on your own family dynamic, but it's the ability to put a roof over yours and your family's head and put food on the table and clothes on their back, the ability to earn a wage, right? Income protection. It's an insurance conversation. And then you've got lifestyle, which is we're comfortable, we like this kind of lifestyle. If our income's protected, so the whole safety thing, I can make sure that we don't starve. What do we do to maintain our lifestyle? Well, it's not necessarily about what you can do to maintain it. It's what you prevent from destroying it. And that could be death, TPD, etc. Again, it's an insurance conversation. That's why you have insurance on the house. And then about the aspirations and the future component, that's probably their superannuation. But you can talk about those three buckets with someone who's retired. I've had advisors say, all they care about is their income, that they meet their income requirements. I'm like, cool, but they're 66. What if they live to 90? Like maybe not 190, but what if they live to 90, right? You've got very different time horizons. They would have no tolerance for volatility around their capital or their income in the short term, none whatsoever. However, they, like we're talking about before, longevity risk, may not have anywhere near enough to be able to live to 90 if they just leave it all in cash. So we need to do something with that. You can talk about your safety bucket. You can talk about your lifestyle bucket, which is, you can take some market risk because you're going to get over the longer term so uplift, which will potentially improve your lifestyle, make things more comfortable. And then what do you want in the future in terms of managing longevity risk or passing something on or having some money left over, or spending money on your grandkids, etc. That's how we've talked about it. It's not the most popular way to do things, but it just fits and feels kind of sensible to me because it doesn't matter what age.
That makes a lot of sense.
Product relevant. There's no product relevance. It's client relevance, and then you go and find what will solve the problem.
Yeah, look, that's a similar approach, and good to know that I'm hearing from the expert that it's sort of around the money. But we in the cases where we've done it with clients, what we typically do is that we will have cash and defensive investments, which is that income, 1 to 2 years of income. Then we typically have equities that, where ideally in a perfect world, the equity income is enough to replenish that year's worth of money. And then, if we hold 2 years of cash or cash-ish, and then we know that every year that the equities are giving us, another year to top it up, then that means that you've got this constant cycle that keeps sort of filling up the bucket. We have only done it though with people where they had like significant money, so that they probably weren't in that position where they were looking at it saying, "Oh, we need to have some level that's gonna sort of do more to cover off that longevity risk or whatever." But for us, we found that makes practical sense, and it's a model that seems to resonate for clients as well. One question, and I don't know, maybe the answer to this is that there isn't anything, but again, being someone that's seen inside a lot of businesses, any other tricks you have or interesting sort of approach that you've seen? Because I think and I know that you're a big advocate for this as well, but one of the biggest destroyers of value and investment returns for clients is typically their own behavior and their behavior.
Listeners, we did not have a pre-meeting and agree that that's what we're going to talk about. So, because I've been up talking about value destructive behavior at every ensemble, everything I've ever been invited to. Good man. Sorry, keep going. That's what.
I was just going to say, do you any other, like I said, like sort of, I don't, maybe trick is the wrong word, but hacks that people use to maybe channel out clients to not make those dumb decisions that destroy the value in their returns?
Well, that dovetails into why I think that portfolios manage to very specific market risk definitions are super relevant and super useful. They're just one way. I've got a whole bunch of techniques you can use because humans are subject to a whole bunch of things because of the way that our brains evolved. And in fact, I'm going to be talking about that at the ALPD session in Queensland on the 28th of May, about why people, in particular, when there's lots of concerning news and things going on, clients and often advisors feel like when they're told you don't need to do anything, that's like the worst answer. They're just not comfortable. They just feel they need to do something. That's actually embedded in the brain and embedded in a primitive component that has evolved over time, while our brain has not. Sorry, a primitive component that has not evolved over time was useful, but we have evolved and the situation has evolved. The most common value destructive behavior that I see and have asked and polled advisors is not necessarily overconfidence. It's not necessarily FOMO. It's more loss aversion, which the academic literature backs. And that is when people freak out when things go down beyond the threat, but if they haven't been told what threshold is. So the reason why I think, one of the reasons why I think a traditional approach to portfolio construction, just having reasonably fixed asset allocations, which by the way is not a requirement of ASIC, reasonably fixed asset allocations, just doesn't make any sense, because whilst they on average over the long term might end up being bang on what the client's overall tolerance for risk is, the client's tolerance for risk is in the moment. what's happening then and there. Telling, enforcing, and teaching advisors over the last 30 years that they have to try and talk people through it, and it's time in the market, and as opposed to actually building stuff that targets that and does everything it can within its power not to breach it while still maximizing return. The first version is just the easy answer for instos. The second version is not easy. It's hard to do, and you can't get it 100% right. But if it is done appropriately, you can tell the client what kind of threshold is there, what the likelihood of having a loss is, what the magnitude of a normal loss would be if it's not like a GFC or tech risk. If they're super technical, they're an ex-engineer, you can talk to them about volatility, though I don't think there'd be a single advisor in the country that wants to sit around and talk about the explanation of volatility or then even the derivation of semi-deviation. That would just be dumb. But if
I'm
you
sure
do
that
it,
there's probably Warren Strybosh, I'd say, he'd be into that.
send them my way with my team. They can absolutely have a conversation. We can talk about how semi-deviation and downside volatility is not quite the same as the volatility of things when they're losing money. Anyway, but if you build the portfolio about those risk parts, about those risk tolerances, nobody likes talking about risk, but if those are the most value destructive behaviors, not doing them in the first place and telling clients in clear language, this is what they're managing to, until you get to or in breach of what it says are the limits, the vast majority of the time the clients are more comfortable. It kind of works. And it's why I don't think the SAA structure, even with a dynamic overlay, makes a whole lot of sense. And there's, the maths has evolved and the testing has evolved and the evidence has evolved to show that we can manage to risk via asset allocation far more effectively. And in fact, if I could get anyone who knows and could get their head around it, whether it's at a licensee level or a PI insurer level, and preferably Treasury or ASIC, the whole idea of minimum and maximum bands in an SAA is to try to manage risk. But the actual asset itself is not the risk. The amount of risk associated with it changes based on price. This is just a ham-fisted way of trying to make sure that clients don't have too much risk by controlling the minimums and maxes that they can allocate to. In reality, what you're trying to do is deliver a solution that does not take on more risk than the client said that they could. And no one's been sued for this, or no one's been called in front of FOSS for this, but make sure you don't not take the amount of risk or the amount of capital market risk or inflation risk or whatever it is that they need to be able to achieve their goals in the future. But if you manage portfolios to those risk components so that you get an outcome that is managed within what it is you said, who cares what the min max bands are? Who cares what the baseline anchored portfolio allocation to equities is? As long as you're managing that risk, it actually satisfies the requirement and not putting them in too much risk.
I think the clients shouldn't care, but I think it is drilled into advisors so much, and largely coming down the line from ASIC, obviously, that it's like, that's how you do it. That's what you're supposed to do. The licensees all doing the same. Even for self-licensed companies like ours, it's like you've still got the compliance people that it's like that is the safe path, but 100%.
I heard a presentation last week where there was a whole bunch of stuff from ex-ASIC member who was saying a lot of the stuff that you're getting from compliance is not a requirement of ASIC. It's an overreaction by compliance, but it's actually restricting the tailorability of results to clients. And this is a perfect example. It does come from the institutional landscape. That's exactly where it comes from, because that's what is built for big pension funds and has been since the 60s to deliver a result that kind of works on average for the most things they can. And so advisors have been drilled into it and told that's what they need to do, and that's how to go about doing it, because that's what happened at the institutional level. No institution set up, no pension fund, no sovereign wealth fund, no whatever was ever set up to deliver a result that is client specific to their circumstances sitting down in front of them. That's exactly what advice is and what they do every day. And so it needs to be agreed that will start from the beginning.
I agree. It's an interesting conversation to have with our compliance team, for sure. Dan, mate, my last question for you, and thank you for sharing all of those insights. But last question is, obviously there's a lot going on in the world at the moment, and you sort of touched on it a little bit before. What are some of the trends that you're seeing, and what do you think advisors should be thinking about as they're helping their client? Obviously, bucketing and psychology and being smart with how we're guiding things, but particularly with where the world is and investment markets are today. What do you think should be most front of mind for advisors right now?
This is a hard one, because the common modeling tools advisors have don't take this into account. Very simple concept. Any asset you buy is worth something in the future. The problem is you don't know what it's going to be worth. Everyone has a guess, and some people are better than others. No one knows. That being the case, if you pay more for it today, then the amount you're going to earn is less. If you pay less for it today, the more the amount you're going to earn is going to be more, right? The best proxy you've got for that, given you can't predict the future, is valuation. And by the way, do not use price to earnings, whether it's price to forecast earnings or price to last year's earnings or realized earnings. I don't use PE when I talk about valuation. But the price being paid at the moment for most assets, or for a lot of assets, especially the big markets in the equity markets, is not cheap. So the forecast returns are lower. Bonds, people think that 4 or 5% bond yield is really high. But anyone with lots of grey hair would look back and think bonds at 6% or below is the outlier, not the norm, because they just were never had a yield that low. Credit's not paying an enormous amount unless you take on way too much risk. And so that being the case, if future returns are lower, and asset consultants and researchers and whatever come out and say it all the time, just keep it in mind when you're talking to clients about realistic assumptions and strategies. Even like a debt recycling strategy, you might say, this is hugely valuable and beneficial to you, but the interest cost versus how much we could potentially earn might not be the best trade-off right now. Perfect strategy. It'll be excellent for you, but now's not the best environment in which to do it. That's me trying to use a practical example, not being an advisor, but hoping that it makes some sense. That's what I think is a serious concern. That, and Trump won't be in power forever.
Both sides of the coin.
Stuff he put in place doesn't mean that it'll be written into stone, but people are acting like it is.
Yeah. It's interesting times out there, and I think it sort of highlights the fact that it's more important, that the government over here throwing us some curveballs around our our rule book for clients as well. So, mate, I'm excited to see it, the ALPD, and dive even deeper.
Fantastic, awesome. Thank you, Ben, and appreciate the questions, and hopefully hopefully it made sense to the listeners and they enjoy it and it was engaging.
That's great. Well, cheers, guys. Enjoy, and be safe, happy investing, and we'll see you at the ALPD.